Finding aggressive equity growth usually means paying an overinflated premium. The modern investor's challenge is locating companies expanding rapidly without overpaying for the privilege. We evaluate companies like this using the GARP framework, growth at a reasonable price. It acts as an analytical lens, stripping away market hype to identify businesses that are scaling efficiently while remaining mathematically grounded. Today's GARP stress test focuses on the industrial manufacturer Carysil Limited. Established in 1987 under the name Carysil, the company spent over 30 years operating as Asia's premier manufacturer of composite quartz sinks. Over that time, they expanded into the fourth largest global producer of quartz sinks, scaling their export footprint across 58 different countries. Today, Carysil operates with a market capitalization of 3,353 crore rupees. This diagram outlines the three pillars of our GARP evaluation. We will test Carysil against sensible pricing, balance sheet health, and physical operational moats. To pass the first pillar, the company must demonstrate multi-year compounding growth that strictly justifies its current stock price. For the second pillar, they need a highly conservative balance sheet, proving this expansion is not fueled by dangerous leverage. If Carysil satisfies all three conditions, it represents a textbook GARP profile. Failing even one invalidates the thesis. Carysil currently trades at a stock PE of 33.9. Assessed in strict isolation, a multiple near 34 often deters a pure value investor. The GARP framework contextualizes this multiple using the PEG ratio, price earnings to growth, which calculates exactly how fast those underlying earnings are expanding. This dashboard highlights primary valuation metrics. Carysil's 1.43 PEG ratio demonstrates the 34 PE is supported by aggressive earnings. Trailing three-year metrics prove this. Sales grew 15.9%, earnings per share expanded 21.2%, and profit variation held a positive 23.7% growth rate. Pivoting to the short term, acceleration becomes steeper. One-year sales growth reached 13.3%. More importantly, one-year profit growth spiked by 54.8%. Carysil clears Pillar 1. A 33.9 PE ratio is structurally sound when backstopped by a 54% profit acceleration and multi-year compounding earnings. We move to Pillar 2. Raw revenue expansion means very little if a company is burning its own capital or over-leveraging its assets. This schematic tracks capital efficiency. Return on capital employed sits at 17.8%, and return on equity follows at 17.4%. Maintaining near 18% returns through global expansion demonstrates disciplined management. This efficiency is driven by a 19.2% operating profit margin. To evaluate downside risk, we look at how they fund this global output. Carysil maintains a highly conservative debt-to-equity ratio of 0.45. They reinforce this low leverage with a 7.65 interest coverage ratio, giving them cash flow to cover debt obligations nearly 8 times over. Zooming in on working capital efficiency, their debtor days currently sit at 63.5 days. For an international manufacturer managing heavy cross-border shipping and global retail logistics, a 63-day cash conversion cycle is exceptionally stable. Pillar 2 is satisfied. Carysil self-funds near 20% margins without resorting to dangerous debt, effectively neutralizing standard downside risks. Financial metrics are just paper reflections of physical realities. To evaluate Pillar 3, operational moats, we have to examine the factory floor. The physical engine driving that 54% profit growth is Carysil's core manufacturing hub located in Bhavnagar, Gujarat. This diagram maps the facility's output. The primary line manufactures 1 million quartz sink units every year. Alongside the quartz, a dedicated secondary line produces 1.8 lakh stainless steel units annually. The Bhavnagar plant now houses an appliance assembly line with a 1 lakh annual capacity, currently scaling to 50,000 operational units in FY25 for chimneys, ovens, and dishwashers. This production is supported by precision German technology, utilizing over 150 molds to output more than 500 distinct SKUs. They apply physical vapor deposition, or PVD technology, to these steel units, securing premium metallic finishes that allow for direct pricing power. Carysil has also executed a strategic pivot beyond sinks, expanding into the built-in kitchen appliance market under their Tech Carysil brand. They complement this with a high-end faucet division running on UK tap factory technology, producing smart taps equipped with boiling and sparkling water features. By centralizing production of quartz, premium steel, and smart appliances into a single Indian hub, Carysil built a massive cost arbitrage moat against Western competitors. The Bhavnagar hub is capable of producing millions of units, but that capacity requires reliable buyers. Carysil exports to over 58 countries, managing the flow through 5 global offices and a 50-member international sales network. Domestically, they distribute through a network of 4,000 dealers, 90 galleries, and 65 franchise outlets across India. They are simultaneously executing an aggressive North American expansion strategy through the U.S. retailer Carysil. This global map visualizes the true scale of their B2B moat. Carysil has secured an allocation supplying 75. Through the Carysil partnership, Carysil products are now actively placed on the shelves of over 1,800 Lowe's stores across the United States. These early U.S. orders have continually surpassed expectations, successfully maintaining high volume without facing pricing pressure or vendor cancellations. Reviewing the framework, Carysil clears Pillar 1 with a 1.43 PEG ratio, backed by highly consistent compounding earnings growth. They pass Pillar 2 by maintaining a pristine 0.45 debt-to-equity ratio while extracting near 20% operating margins. Carysil passes the GARP test entirely. They have translated a localized manufacturing advantage into deeply entrenched relationships with global retail giants, compounding their equity value with strict financial discipline. Keep in mind, this breakdown is strictly for educational purposes, not SEBI-registered financial advice. Always conduct your own independent research, as all investing involves risk.